Yeah, hello and welcome to today's lecture. We are now reaching the end of this macroeconomics course. I hope you enjoyed it. If you have any suggestions, ideas how to improve it, please let us know. We will try to record the whole course a second time in August. So then you will have the chance, if you're interested, to watch it again and try to improve it also technically a bit. So please go to our website by, I would say, mid-August, and if you're interested, then you can get the kind of refined version of this lecture. Of course, if you do something for the first time, you always have to do it, and then the only way to realize how to improve it. But yeah, if you have any suggestions, what might be improved, if you have suggestions, what you think is missing, if you have suggestions of what you think is redundant, please do not hesitate. This is very welcome. Okay, so in this very humid room now, I try to discuss with you also a hot topic today. We will talk today about the euro crisis. The euro crisis was an event that occurred somehow overnight. So it was by the end of 2009 that suddenly people realized there's something wrong with the euro area. It's quite interesting because, as you might know, we had this Lehman crisis in September 2008. Then we had this strong downturn of the global economy, which was called the Great Recession. And so by the end of 2009, it became obvious that fiscal policy, monetary policy in the large economies had been sufficient to stabilize the economy, to prevent a continuous slump as we could observe it in the 1930s, which was called the Great Depression. So by the end of 2009, one had the feeling, oh, well, the worst is over. The global economy is stabilizing, growth is coming back. So there was a kind of mood of optimism that the worst is over. And then suddenly, by the very end of 2009, early 2010, suddenly people realized there's something wrong with the euro area. And it's quite interesting because at that time, I was a member of the German Council of Economic Experts, and this council writes a report always in autumn, which is then presented to the Federal Chancellor by early November. And when we wrote this report, 2009, we didn't see major problems for the euro area. We saw that something is difficult, maybe something has to change, but that a euro crisis is imminent only 2 months, 6 weeks after we've handed over this report to the Chancellor was not clear to us. And as a kind of apology, one can say, well, all the other observers did not realize that the situation in the euro area might become so difficult in only 6 weeks, 2 months. So what is this euro crisis? What were the causes of the euro crisis? How could the situation stabilize? And what can one do to prevent such crisis in the future? That's all what I would like to discuss with you today. So the euro crisis. So how did the euro crisis become manifest? The most obvious sign that things became problematic this kind of indicator for crisis are the long-term bond yields of the member states, and you can see it here in the first spike here in bond yields started in early 2010. You can see here before we talked about this, that in all the years of the existence of the euro, even during the Great Recession, bond yields have remained relatively low. There were no pronounced differences in bond yields So there were no signs that the markets were expecting major problems in the euro area. And so the first time that the markets woke up and realized something's wrong was in early 2010. We can see here, it's a gray line that suddenly the Greek bond yields increased quite a bit. So these are percent here. So very short period of time, then suddenly long-term bond yields for Greek government bonds increased and reached levels of more than 10%. And you can see here it's kind of waves of prices. So of course in Greece there were several waves until bond yields reached levels of 50%. So Greece was the first country where the crisis became manifest, but then other countries who got into troubles were Portugal and Ireland, here and here. They can also see that the long-term bond yields went up. It was a little bit later, so this was in 2011 and early 2012. So there were different phases of the crisis. So the first wave hit Greece, and the second wave hit Portugal and Ireland, and the third wave then again hit Portugal. So what do these high bond yields mean? They imply that countries are no longer able to refinance their outstanding debt via the capital markets, because if you have to refinance public debt with interest rates of more than 10% or 10, 15, or even 20%, then as a country you are no longer able to keep your debt somehow stable, because with interest rates of 10 or 15% or even more, your debt gets out of control. And so when the markets suddenly realize that something's wrong in Greece, and I've shown you the data last week that already in 2007 one could have identified major problems in the public debt of Greece, but when the markets realized it, long-term bond yields went up, and then countries realized at these rates it's not possible to refinance the outstanding debt, especially in a country like Greece, which already has a relatively high debt level. And so Euro crisis means that the markets were no longer willing to refinance the outstanding debt of member states at somehow acceptable rates. So that was the clear sign that crisis is there. And what we will do now first is to discuss how was what caused this crisis, what are the causes for the crisis and for the difficulties of countries like Greece, Ireland, Portugal, and to some degree we had also relatively high interest rates. Also here the blue line for Spain and for Italy. They were not that high, but still more than 6%. These are also rates that are difficult for countries. So why did it happen? What happened in the euro area? What caused this this crisis? And of course, there's one main reason why the situation of a member state in the euro area is more difficult than the situation of a country like the United States, and we have addressed this already last week. It's due to the fact that a country like Japan or the UK or the United States, they have all their debt in their national currency. And if capital markets are no longer willing to finance the debt of such countries, there's always a central bank who can step in and can then purchase government bonds. And by purchasing government bonds, it can keep interest rates low. And I think that's what we see today in the Corona pandemic, where we have huge government deficits, and they're all 100% or more than 100% financed by central banks. And the situation is different for the member states in the monetary union, because countries like Greece or Ireland, all the member states, all their debt is denominated in euro. And National Central Bank of Greece, of Ireland, they are not able to purchase the government bonds of their government. So there is, for a member state in the euro area, there's always a risk, and that's what happened with Greece, that the capital markets are no longer willing to finance government debt, and that the European Central Bank does not step in to fully stabilize the situation. And that's something also which is difficult for the European Central Bank. It cannot unilaterally help member states, because this is not compatible with the Maastricht Treaty. So there is this risk for member states, and that's what happened, that the financial markets practice kind of sudden stop. They're no longer willing to purchase government bonds, and then the logical consequence would be that a country is insolvent, that it is no longer able to repay its debt, that we get kind of insolvency procedure, that we get a debt restructuring. But as this is associated with lots of problems, the solution in the euro crisis was that the other member states stepped in and helped those countries that were affected by the crisis to somehow refinance their debt without a major debt restructuring. The only country that had some debt restructuring was Greece, but all the other member states could manage the situation without a debt restructuring. And how all this was achieved, we will now explain in a minute. Okay, euro crisis means bond markets are no longer willing to refinance member states. Member states need the support by the other member states in order to avoid insolvency, and all this we'll explain now in more detail. So the question is, how did it come to the crisis? Why was there a euro crisis? And the interesting thing is that there are different narratives how the crisis was caused, and narrative also is always a story about the good guys and the bad guys. So who is to blame? Who are the culprits? Who are the good guys? And the interesting thing is we have two different narratives of the crisis. And how can one explain that economists come up with two different narratives of the crisis? Well, those of you who have attended our course from the very beginning might get an idea that if you have different paradigms, different macroeconomic theories, and if you apply these theories to specific problems, then of course you can also get different stories. And this is quite plausible, as I've tried to show you, that these two paradigms, the classical paradigm and the monetary paradigm, have completely different mechanisms. And so if you apply these theories, these paradigms, to a concrete problem, it's not surprising that you get different stories. And so the euro crisis is a very nice example how different paradigms lead to different explanations, and also to identifying different bad guys and good guys. So what are the two narratives? Well, we have the classical narrative, and the classical model, saving of households is always the key driver of everything that happens. Households that save, they are the motor, so to say, they are the driver of everything that's going on. So that's very important. The key feature of the classical model, all that happens comes somehow out of saving decisions of households. And of course, that's logical, because the saver in this model, he is the dominant, he has a dominant role, and all the other players more or less can only passively react to what's happening by the saver. And so the classical narrative of the euro crisis, that there were savings from core countries, especially from Germany, and these saving like a flow came to the periphery countries, Spain, Ireland, Greece, and Portugal. And now this flow of savings did not go to the productive, did not go to productive uses. No, it was misallocated. So the story goes because there are local politicians who have a strong preference for the real estate sector and not so much preference for the manufacturing sector. So the politicians were favoring, by all kinds of regulation, the sheltered construction sector. And so this flow of savings came into the construction sector where it was suboptimally allocated and created a lot of disaster. So that's a little bit the story. So the German saver is not a bad guy in a sense. He just saves so much, and the savings must go somewhere. And so the savings flow then to Spain. But here in Spain, then you have the bad guys, the local politicians, and they make the life difficult for the manufacturing sector, for the national sector. And so all these savings are absorbed by the construction sector. They're also, banks are also somehow criticized in this narrative, but the banks cannot do so much in this narrative because they just intermediate the German savings to Spanish households, Spanish real estate investors. So they're also somehow bad guys, but their role is not so dominant because they just can, there is this flow of savings and they just have to intermediate it. So that's the story, a classical story, and you can find it in a paper by Brunnermeier and Reis. There are also they have also several series of presentations. I think should give you the link where they develop this narrative. The monetary narrative is different, and in the monetary narrative, always banks play a decisive role. Banks and investors. These are the guys who are relevant who have the dominant roles in the story. And in the monetary narrative, the story is as follows. There are investors, people who want to buy real estate for themselves or as an investment, who speculate with real estate. There are banks, Spanish banks, who are willing to provide the financing for these real estate transactions. So the story starts from Spanish banks and Spanish investors. And as we know, in the monetary theory, there are no real limits to this lending by banks to private investors. Because as we have shown, the loans create the deposits, and of course banks in this story do not need saving or savings, whatever. So there's no role for Spanish savers or other savers in the story. It's really the drama is Spanish banks and Spanish investors, be it private households who buy the house for themselves, but in Spain people also like to buy a second or third home. There are also kind of construction firms. So that's where the story starts. And what happens if you have a lot of bank lending, if you have a lot of construction, of course, GDP grows, there's a lot of expansion in the economy, incomes grow, and out of these incomes, in an open economy like Spain, then also they import more products from other countries. And I would say in the case of Spain, there was a lot of incomes were generated. What did people do? They bought nice German cars. And so the Spanish story affected Germany via the import of German cars by Spanish households and Spanish firms. And so this had, of course, impact on the German economy, because now German firms, BMW, they could sell all these nice cars and they made huge profits. And profits of companies are more or less identical with the saving of companies, because saving simply means your net wealth increases. So as a consequence of the whole story, German companies made profits, and these profits is what we have in the national account statistics, is what we call saving. So investment and bank lending in Spain caused profits, which means saving in the German economy. So it just goes the other direction. And what also plays, what's still lacking to close the story. So if Spanish households buy many German cars, of course these cars must be paid. And so from Spanish banks, transfers are made to German banks. The payment from to Germany for the German cars increases the bank deposits of BMW, but it also increases the net as the increases the claims of German banks via Spanish banks. Yeah? And here comes a second. Here comes one element: how Germany finances Spain. So the German banks who have increasing claims on Spanish banks could have asked these Spanish banks to settle these balances with central bank money, but instead the German banks were willing to lend the balances that they had vis-a-vis the Spanish bank, to lend them for a longer period of time. So the German banks were willing to finance the Spanish banks, so that the imports of German cars to Spain could be financed. And so we have, in this story, we have Spanish banks and Spanish investors who really get the whole story started. And then we have this transfer to Germany via Spanish imports of German cars. And then in the end, we have all the German banks that finance the Spanish banks. But you can see it's a completely different story. And the German German households do not play a role at all. And if German savings play a role, they are the result of the whole process. And so the culprit here is not the first instance Spanish politicians, it's Spanish banks, Spanish private investors, and German banks who were willing to lend large amounts of money to Spanish banks. And of course, this is not a minor thing, how you tell the story, because in economics, it's always a story about the market and the state. And in this financial crisis, there's a lot of debate, who is to blame? Is it the private sector? Are the markets the culprit, or is the government responsible for the financial crisis? And in this classical narrative, it's mainly the government got it wrong, not the market. And in the other story, for the monetary story, I don't need governments. I just have the banks in Spain and Germany, and of course, Spanish investors who buy houses without asking themselves, well, this is a good investment. And so I think that's why these narratives really matter, because in economics, we always have this question, who does it better, the market or the government? We have this debate also today in the COVID pandemic. Did the government really a good job, or is it to blame? So this is a key question that always resonates in economic discussions. And therefore, I think it's interesting to compare these narratives. But let's go a little bit into the details. Before that, very short, there's no word which is so badly treated like saving or savings. If you go through all kinds of economic texts, you can see that the most prominent economists use saving and savings as identical. And this is a problem. Why? Because saving is a technical term. You find it in the national account statistics, and saving is a flow variable. And saving means the increase of net wealth during the accounting period. And saving means, how can you increase your net wealth? You can increase your real assets, or you can increase your net financial assets. So that's, saving is a clear and nicely defined concept, and it's a flow variable. What is savings? Savings is just nonsense. Savings is not a technical correct term in economics, because it has no, has no, it's not, you cannot find it in any statistics. There's no such thing as savings. But if you would like to, if you try to define savings, it's definitively not a flow variable, but a stock variable. So if you say my Aunt Mary has a lot of savings, you want to imply she has a lot of money on her bank account. Definitely, if you say she has lots of savings, you do not want to say that right now she's saving a lot. You want to say already she has a lot of money somewhere. So savings, if it must have any meaning, it must be a stock variable, and stock variables are variables that are defined at a certain point in time. So using saving and savings as something identical means you mix up flows and stocks, which is a catastrophe. You should never do that. But the very fact that you find it in, whenever you read something on saving and savings, you can see that most economists really mix it up. And of course, this is why is this a problem? Well, with the word savings, you give the classical model some kind of plausibility. You know, if you say, I give him my saving, I lend him my saving. Say saving. If you say, I give him my savings, then it sounds quite plausible. And then it's true, because if I lend somebody something, I can lend him a certain amount of money which I have on my bank account. So I can always have seen it discussing the monetary approach. Lending, the monetary approach is always providing somebody some money balances. So of course, if you lend savings. Yeah? And so the nice thing is, if you want to give a plausibility to the classical approach, where the only thing that you can supply is saving, by speaking of savings, it sounds much more plausible. But I would say it's a disaster for a science that such a key term is misused in such a way. So let's now look at the classical story. So we just quote from the Brunnermeier-Reis crash course on the euro crisis, and it's a wonderful exposition of classical thinking. So it starts: savers in the core regions make short-term deposits in core financial institutions. It's wonderful. It's our all-purpose good. So the German savers have this all-purpose good in their garage, and now they bring it to core financial institutions. They make short-term deposits. They take the all-purpose good from their garage, go to Deutsche Bank, say, here is our all-purpose good, now you can lend it. These institutions send the capital, now the short-term deposits become capital, through the wholesale market as short-term loans to periphery financial institutions. So the Deutsche Bank takes the all-purpose good, sends it, I don't know, with our cargo ships, or sends it to Spain, to periphery financial institutions. The periphery banks lend funds. Now the short-term deposits become capital. Now there are funds to projects privileging sectors like housing that have tangible collateral, and deep securitization markets providing a new dimension of misallocation. So the German savings end up in housing. Part of these loans were used to pay for wages. So now this all-purpose good, part of the all-purpose good goes to households. And then it's a little bit strange that were then used to pay for imports of intermediate inputs from the more productive and competitive core countries. So they didn't buy BMW cars, which they did, but they, I don't know why they need imports of intermediate inputs. So, and now so the all-purpose good flows back to Germany, to the firms in the core countries. And the core firms in the core countries deposited their cash inflow in core banks, which wholesale bank lends back to periphery banks. So it's a full circle. Yeah. So nice story. So, and you can only understand it if you have this all-purpose good. The German saver says, I don't want to eat my all-purpose good. I have already eaten enough of it. Let's save it. Let's bring it to Deutsche Bank. And Deutsche Bank says, oh, we don't need it. So maybe we call the Spanish colleagues, do you need the all-purpose good? They say, oh, yes, they lend it to us. Then there are the Spanish banks. And then what can the Spanish banks do with it? Well, there are these local politicians. They say, hey, you must give it to the construction sector. Spanish banks would have liked to give it to manufacturing sector, but no. The politicians say this must go to the construction sector, and then the savings are wasted, and a little bit remains, and then the all-purpose good flows back to BMW. The BMW takes the all-purpose good to the Deutsche Bank, and so on and so on. Nice story. And here you can see it. So we start with the German savers, with the short-term deposits, with capital, funds, wages, immediate inputs, and then the circle. And so the German saver is not addressed the second time, but that's the story. Funny story, but very flawed. It's really amazing that two so prominent economists tell such strange stories. And it's really a nice example how the thinking in classical categories creates such nonsense. It cannot find a better word for this. So that's the story of Brunner-Meyer-Rice, and the story is somehow explained even a little better by Hans-Werner Sinn, former president of the IFO Institute in Munich, a very influential German economist. I would say for many years, probably the most influential German economist, who tells the same story, but a little bit more, I think, even more impressive. So, and he elaborates a little bit on this story. He said, because the savings capital flowed out of Germany, now say, what is the consequence for Germany? Well, there are no savings in Germany for investment, because the all-purpose good, it flows away to Spain, and the all-purpose good is not available for investment in Germany. Too bad. He said, the country said, there was little invested, domestic demand slackened, and the rate of inflation and wage increases were low. The price restraint improved the competitiveness of the export industry and led to a high export surplus. So one positive thing, he said, because the economy was in such a bad shape, wages could not increase, and therefore somehow improved our competitiveness. And then you get exactly the story. Germany exported its savings instead of converting them into loans for the domestic economy. That's the logic of this all-purpose good. You can only use it once, and once it is invested, it's no longer available. And so there is a kind of trade-off. If you do not invest, if you invest the all-purpose good in Spain, you cannot invest it in Germany. And then it goes on, because of lack of investment, Germany has only been able to realize little growth. And so Hans-Werner Sinn sums it up. This is the basic law of capitalism. When investors want to shift capital from region A to region B, B booms and R goes into the doldrums. For most of the time after the announcement and introduction of the euro, Germany was doldrums region A with the current account surplus. So that's, I think, it's even formulated a little bit more, more interesting than the Brunner-Meyer-Rice story, but it's exactly the same. You can nicely also realize the classical approach. And the main question is, why did the funds flow from Germany to Spain? The question has to be answered, what happened? And one can say yes. Within the logic of the classical model, you can say yes, with the monetary union, the capital markets of Germany and Spain were much more integrated. And in the monetary analysis, one could say yes, because there is no longer an exchange rate war, because German banks wanted to lend to Spanish banks, and the currencies are different. D-mark and peseta. Lending within Europe was always associated with an exchange rate risk, and bank regulations tried to keep exchange rate risks low. And so without the euro, lending between Spanish banks and German banks would have been difficult because it always implies exchange rate risk. And so you can say, yes, with the euro, the capital markets were more integrated. And that implies the following. So before monetary union, you have the Spanish capital market and the German capital market. This is now all in the logic of the classical model, the loanable funds model. And so in Spain, the interest rate was higher, and in Germany, the interest rate was lower. And now with the opening and the integration of the capital markets, get a new equilibrium with a common real interest rate. And this common real interest rate means that the interest rate in Spain declines, interest rate in Germany increases. And now, once you have monetary union, savings in Germany exceed investment in Germany. And this surplus can now just be used to close the gap between saving in Spain and investment in Spain. So that's a little bit, if you think in terms of the classical model, that's what you need to get these flows started. And astonishingly, Brunner-Meyer-Reis, they don't even explain it. Why is there suddenly this flow of saving from Germany to Spain? But that's the classical story. And yeah, this story, so Hans-Werner Sinn does not really have the culprits in his story. In his story, it's a little bit, Germans are a little bit dull. They don't realize that they give away their nice savings to Spanish investors who just spoil it. So Germans are a little bit stupid. While in the Brunner-Meyer-Reis story, it's local politicians who are really ugly guys diverting the nice flow of capital coming from Germany into completely unproductive uses. So what is the monetary, how can you explain the prices and categories of the monetary model? Well, you have, as we already said, you have Spanish investors who have the feeling that real estate prices will go up and up, and to just speculate in real estate. And of course, if many people speculate in real estate, buy houses, buy apartments, prices go up, and then investors see, oh, prices go up, maybe we should buy more houses. So you had a kind of speculative bubble in the housing markets. There was a lot of construction, people bought no houses. So what matters in the monetary model is really the decision of investors to buy houses and apartments. That's the key driver. And of course, this spending decision must be met by banks who say, we give you the money. Because all these speculative investments in the real estate markets are not financed out of saving or savings, they're just financed by banks who don't need saving or savings, who just give loan to the investors. And so this process can go for quite some time. We've discussed this already. And if the bank supervision doesn't step in, and if the ECB, what it did, provided a refinancing at a relatively low, constant refinancing rate, so this process can go on for quite some time. And then the repercussion so the process starts in Spain, and then of course it has effects on Germany, but only as a kind of follow-up effect. And that's what we already said. If the economy grows in Spain, people have higher incomes, they buy all kinds of German products, and they don't buy capital from Germany, they buy consumption goods like cars. Of course, car can also investment good, but more or less they buy investment goods. And then, of course, the deposits that are created by the Spanish banking system go now to German banks as payment for the cars that Germany exports to Spain. And the result is what I already said, that German companies are making high profits, and the profits of the corporate sector is the saving the corporate sector. And what we can see in Germany in these years is that not the households were saving more, but that the corporate sector made the saving in the corporate sector went up. And that was a result of what was going on in Spain, and not the cause of the processes in Spain. And then, as I said, then the payment for the German products implied a shift of bank deposits from Spanish banks to German banks. It means the payment from Spanish households to BMW means that the reserves of the German banks went up, the reserves of Spanish banks declined, and the solution to this liquidity gap by Spanish banks and the liquidity what is it? Surplus, yeah, of the German banks could easily be solved by German banks lending their liquidity, making interbank loans to Spanish banks and refinancing the Spanish banks. That's how it worked. And as I said, the conclusion is that German saving was a consequence of what happened in Spain and not vice versa. And the German savers are completely irrelevant for the whole story. You can see it here again. So it starts with the Spanish banks giving a mortgage to Spanish real investors. Then you have the Spanish consumers. Strong economic growth means that wages go up. And then they buy the German cars, which means profits for German firms. And then they make bank deposit with the German banks, and with interbank loans, German banks finance Spanish banks. So that's, I think, a very simple story. But in the center is this banking system, and the investors, and saving is just a side effect, but nothing that has any relevance for the whole story. So we can just now go a little bit through the charts, and you can see, in fact, an immense increase of bank loans to the private sector here in Ireland, in Greece, and in Spain. You can see this chart starts in January 1999. You can see that bank loans increased by a factor of 4 to 5 in Spain and Greece and Ireland. So this is exactly what we described in the monetary model, the ability of banks to create excessive bank loans out of the blue. And you see it's just a very short period of time, 1999 to 2008. So it increased by a factor to 4 to 5, which is really almost unprecedented. So bank loans played a huge role. Interestingly, that's quite nice. In Germany, at the same time, you can see this orange line, bank loans stagnated. So Germany was, in fact, a region where nothing happened, which was somehow frozen. And the question is, why was the German economy so frozen? Was it due to the fact that our saving went to Spain or Ireland or Greece? No, it's another explanation which I will provide you in a minute. So, and what you can see, you had a huge boom in residential construction, especially in Ireland. So it increased by a factor of 5, and you can also see it here in Spain, increased by a factor of almost 4, and also increased, not that much, but it's still excessive increase in residential construction. And again, Germany is to say the cool country where nothing happens at all. So you have bank loans financing residential construction. And you can see also a huge increase in real estate prices. Again, the same picture, increase of real estate prices, nominal real estate prices by a factor of almost 3.5 in Ireland, of almost 3, or more than 3 in Spain, and also still factor of 2.5 in in Greece. Again, also really quite interesting, this gray line where nothing happened is in Germany. It's quite interesting, these completely different developments in the same period. So it's always a period directly after the introduction of the euro. Quite interesting. Yeah, but so this is quite, in my view, quite plausible story. A lot of bank lending, a lot of construction, and the whole process is, of course, driven by the strong increase in real estate prices, so the kind of really speculative process. So what I can also see is a strong increase of imports in Spain and Greece. So as the economy was booming, imports went up, and you can see here Germany, some increase in imports, but much less. And of course, the increase in imports in case of Spain and Greece exceeded the increase in exports because there was a lot of consumption going on. And Germany had some increase in imports. Also, the economy was relatively stagnant, but this is due to the fact that German companies were importing many intermediate parts which were the imports for the exports of the German economy. So the imports does not mean that an economy is using the products for itself. A lot of these imports were imports for all kinds of export products, because at that time the German economy was exporting quite a lot because the Eurozone outside Germany was growing quite a bit. And so the German imports do not mean that this was really used by Germans. It was mainly the immediate products for German exports. And what is obvious, if your economy is growing quite a lot and you're importing many things, you can see here in Greece, huge increase in current account balances, and they're really huge. So these are the data for 2008, and so in Greece, the current account deficit was minus 15%. And so it's, in retrospect, it's really amazing that nobody was very much scared about the situation in Greece, 2008. Nobody talked about it. And the same thing in Portugal, current account deficit of 10%, and also in Spain, it's very, very high current account deficit. So, and current account deficits are not necessarily a bad thing, but they're always a matter of concern. If countries have such pronounced current account deficits, it shows that the country is not able to export as much as it imports. And of course, current account deficits always mean that your net financial obligations vis-a-vis the rest of the world increase, because it has to be financed. If you spend more than you earn, and that's what a current account deficit shows, then of course it means that the financial obligations increase. And so these are data of 2008. One could have seen somehow that something's going wrong. And the opposite mirror image of the current account deficits in these peripheral countries are this increasing current account surpluses of Germany. So when monetary union started, Germany even had a slight current account deficit, and over the years, Germany had a very, very high current account surplus. And this is due to the fact that the German economic growth was very weak, but they were able to export a lot. And of course, the consequence is that you get such current account surplus. And so this leads us to have a look at what's going on in Germany. In the story of Brunner, Meyer, and Reis, Germany doesn't play a role. And in the story of Sin, Germany is a little bit stupid, that they are not realizing that they could have used the savings better for German investment. But what was the reason of this very stagnant situation in Germany after monetary union? And here you can see this. Here we have the unit labor costs. And what you can see here, that in Germany, especially until, let's say, 2008, German unit labor costs did not increase, while in all the other member states they increase. And what is the explanation for the stagnant unit labor costs in Germany? Well, this is what one can call the German wage moderation, and German wage moderation is not something that was like something that came from outside to Germany. German wage moderation was a feeling in Germany by the trade unions, but of course also by the companies, by politicians, that Germany's competitiveness is in danger, that Germany is no longer able to compete successfully in global markets due to the competition coming from China, coming from Eastern Europe. So in Germany there was a kind of angst that our whole export sector is in danger, and the result of this was a kind of implicit consensus of all relevant groups in Germany that the only way to save the German export industry is to keep wages low. And this was translated into a policy where there were no more wage increases for higher productivity. And so you can see the unit labor. So there was some wages somehow compensated for inflation, but they did not compensate for increases in productivity. And so we had this almost constant unit labor cost. And of course, this was completely different in all other countries in the euro area. And the main direct effect of stagnant unit labor costs, more or less, or stagnant wages, is that domestic demand in Germany was also stagnant for quite a long time. It's quite impressive. For a long time, no increase in total domestic demand. And in contrast to this, we have again our friends Ireland, Greece, and Spain, where due to the bank lending, due to the higher wages, due to construction, domestic demand increased. So the euro crisis is, so to say, the result of several factors coming together. It's of course what we have discussed, all the bank lending, all the real estate boom in the periphery countries, but at the same time there was this distinct German strategy to say we have to keep our wages more or less constant in order to protect our competitiveness. And this, as a result, of course, acted as a brake to domestic growth in Germany. And of course, with stagnant domestic demand, there's also no interest of the people to buy houses. So that's why the bank loans remained more or less stagnant. That's why housing prices remained stagnant. And this cooling down of the German economy had a dampening effect on the euro area. And it also prevented the ECB from raising interest rates sufficiently to stop the real estate boom and the overheating in the periphery countries with higher interest rates. So these two different processes coming together were the main reason why this euro crisis was so severe. And I think that here, let's see. Yeah, let's just have this chart. So, and as I said, some element that was needed to keep the process going was a willingness of German banks to refinance the Spanish banks, to refinance to some degree the current account deficits in Spain. And you can see it here. These are the bank loans from German banks to Greece, to Ireland, Portugal, and Spain. And you can see, yes, there was this is in euro billion. There was a quite strong increase of this overall lending to countries like Spain, like Ireland, not so much to Greece, but overall, German banks were lending quite a lot of money to refinance the banks in the periphery countries. But what is important to say, isn't that the story by Panama and Reis? Did not the German banks finance the Spanish banks? But you have to look at the quantity. So here we have the orange line is the German bank loans to Spanish banks. And here you have the bank loans of Spanish banks to the private sector. And of course, it's only very tiny, relatively tiny compared to the overall lending of Spanish banks. While in the Brunner-Meyer-Rice story, these two lines, the orange line and the blue line, should be identical, because in the Brunner-Meyer-Rice story, the Spanish banks can only lend to Spanish investors what they have received as capital from German banks. And here you can see that from the magnitudes, this is definitely not the case.
Maybe we did receive a question,
yeah.
And I think you sort of answered it already, but maybe we just want to add something. So why is the German saving financing the Spanish bank in the monetary model? I thought that this is a key element of the classical model, not the monetary model.
Yes, no, the German saving didn't finance anything. As I said, German saving, the only sector where you could see an increase in saving were the corporate sector, and the saving of the corporate sector are the profits of the corporate sector. And of course, due to the strong demand from periphery countries, German companies made lots of profits, and this is the saving of German companies. But the saving, the profits, are the result of all the process. They have no effect whatsoever on the financing of the process in Spain. Okay, so we have also maybe one element, third element, that also has to be addressed, which is not addressed also by Brunner-Meyer-Rice and not addressed by Sinis, that of course in Greece we had a problem with excessive government spending. So this is something that has to be said and mentioned. So if you look at real government expenditure, the increase in Greece was really very high, much higher even than in Spain. And so you can also see that if you look at the fiscal balances, so the fiscal situation in Greece was really very bad and very obvious. And again, these are data for 2008, which is quite interesting. So if one talks about the culprits of those who are to blame, the government or the market, I think in the case of Greece, definitively there is a role for the government which did not somehow try to maintain fiscal balance even in very good years. And the interesting thing here is if you look at Spain until 2007 and Ireland, oops, here you can see these countries, the year before the crisis, they had even a surplus because the economy was so strong. This real estate boom generated huge revenues for the government, so they had a surplus. Yeah? And it only changed, of course, in 2008 when the crisis broke out. Then they suddenly had a deficit. But it's interesting that in Ireland and Spain, in the years when the problems emerged, they had a surplus. So but you can see, so compared to Spain and Ireland, you can see that how difficult and problematic the situation in Greece was, that although everything was booming, they still had this huge deficit of minus 10%. Okay, but now here we can stop, make a short break, and then 10 minutes we come back and talk about the rescue mechanisms. Thank you. So let's start again. So now we've seen the different narratives of the euro crisis, and we've seen that these narratives always have a political dimension. They address the question who is responsible for the crisis, and of course, as I said, in economics, it's always the big debate, who is the bad guy and the good guy? Is the market the good guy and the government's the bad guy, or is it the other way around? And I hope I've shown you a little bit that it really depends on the narratives. In the classical narrative, the market did no major mistakes, but the politicians are responsible, and in the monetary narrative, it's really the banks, the speculative investors who caused all the problems. So now the question is how, once the countries, governments have lost the ability to refinance themselves on the market. How could they rescue? Of course, without any rescue, we would have seen government insolvencies, governments confronted with the fact that bonds become due, have to be repaid, and the governments are not able to raise new money on the capital markets, and that would just be a government insolvency. That would have been a disaster. And of course, nobody wanted this disaster, and therefore, once countries lost market access, the question is how to help them. And here again, you have this the long-term bond yields. You could see how Greece, above all, but also Portugal, Ireland, lost market access. In Spain, the problem was not that severe. Spain, it was mainly a problem of the banking sector. The question is how to help these countries, and the solution was that the other member states decided we have to help them out. We cannot allow widespread government insolvencies within the euro area. We also do not want to dissolve the euro area. There were also German economists like Hans van der Sinn, we have already heard of him, so who said just give it up, the euro area, let's go back to national currencies. It was a bad idea, the euro from the very beginning, and so we just have to stop it. But the political decision was we have to keep the euro area intact. We have to save monetary union. And therefore, the only way to help countries without market access was to say, okay, let's find mechanisms how we raise money together at low rates, and then we take the money and give it to the countries that are in trouble. And the mechanism how this rescue programs were organized was first European financial stability, and then since 2012 the European stability mechanism. And these are just financing vehicles which are funded by the member states. So the member states pay in a certain amount of capital as a backing for these vehicles, and these vehicles then are able, with the backing of the member states, to raise money on the capital markets at very low rates, and the money that they raise can then be given as loans to countries like Greece, Ireland, or Portugal at low interest rates with very long maturities. So that was the idea of these rescue mechanisms. Important element of these loans, these rescue loans, is that the healthy member states, so to say, only were willing to provide loans to countries in trouble if these countries are willing to undertake substantial reforms, substantial economic reforms. And in order to guarantee that these reforms were also implemented, all the loans, rescue loans in the euro area were monitored by three institutions: the European Central Bank, the European Union, and the IMF, the so-called Troika. So these three institutions monitor the process of economic reforms in the member states on a permanent basis, and they enforced harsh reforms in member states. That's why this Troika was very much criticized in countries like Greece, because I would see it like this, because they asked for very, very restrictive fiscal policy measures, especially in the case of Greece. Greece had to undertake fiscal policy austerity that was really unprecedented in economic history. And of course, the result of this austerity was a huge decline of economic activity in Greece. So in Greece, more or less, they had a decline of GDP about 20–25%. Development that was unique for Greece, and which was thank God not observed in the other countries. But that's the logic. So euro crisis means countries have no more market access. They need funds to repay loans that come due. That's why the other member states have established these financing vehicles. these vehicles had a capital backing by all member states, so they could raise money at low rates on capital markets, and then these loans at low rates were then also given to the countries that were in trouble, but only if these countries are really willing to undertake comprehensive economic reforms. And in order to guarantee this, we have this troika that monitor this reform process. So the European Stability Mechanism was established in 2012. First institution was the European Financial Stability Facility that was established in 2010, but only as a transitory institution. And in 2012, the Euro area heads of state had to realize we need a permanent stabilization mechanism, and that's the ESM, European Stability Mechanism. And you can see the member states all the member states have a capital key. So Germany, for instance, has a capital key of 27% in the ESM. So the subscribed capital of Germany is about 190 billion euros. So far, Germany had paid 21 billion euros. And the capital keys of all member states sum up to 700 billion euro. The idea is that the lending facility of the ESM is only 500 billion euro. So there's a kind of overfunding of capital in order to guarantee that the ESM is always solvent, even if some of the member states are no longer able to provide their capital subscription. And also, this overfunding is also made in order to guarantee a AAA status of the ESM, because some of the member states don't have a very high rating, and so with this overfunding, it's guaranteed that the ESM is always the best rating, and the top rating means you can borrow at very, very low interest rates. So you can see it here on how it worked. So let's take Greece. You can see here in Greece, the crisis started somewhere in 2010. And you can see when the market rates went up, and the gray shaded area is the market debt. And you can see how an increasing amount of the debt, the market debt of Greece, was transformed in ESM debt. So in this case, it's not only ESM, it's also ESFS. But debt, but it was the private debt was transformed into public debt, guaranteed debt at low rates, and that's what helped Greece to survive. There was also a certain restructuring in the case of Greece, so private bondholders had to accept a certain haircut on the bond holdings. But you can see how a major part of the debt of Greece was now transformed into debt that was financed by the ESM and by public institutions. So the same process here in Ireland, and not as pronounced. We also have it here in Cyprus, which also had a major rescue program, and in Portugal. So the logic is to transform market debt into public debt, and the advantage of public debt is that the interest rates are very low and that the maturities are very long. So that's really helps countries to survive when they are confronted with a crisis on the capital markets, and you can see it here. So you have here again the market yield of Greece, and you can see the rates at which the Greece could get money from international institutions, much lower, but still. Look at this soon. Was still in the beginning, Greece had to pay relatively high interest rates for the rescue lending. So, but I think we just look at the data. I think it's quite nice to see the data. So let's see Greece. So the first programs were in 2010, 2011, and at the beginning, The borrowing was just made by the other member states. So at that time, they did not have these vehicles. You can see the beginning, the maturities were relatively short. And what is interesting, Greece had to pay relatively high spreads. So the rescue was not that Greece got money at low rates. They got somehow the money, but not at very low rates. So more or less, you can say the donor countries made some profit because they asked for Greece to pay a spread on the rate at which the strong countries could refinance themselves. This was, in my view, absolutely was quite stupid idea, because if the country is already in trouble, that you just ask the country to pay a spread over the market rate, that was absurd. But that was also a German idea. So the idea was a little bit to punish these countries. So at the beginning, 2010, the German approach was, these debtor countries have made something wrong, so they have to feel the pain, and the other countries have to see, if you make such mistakes, you will suffer. We do not bail you out. We don't provide you an easy way out. So you have to feel the pain in order that you will never do that again. That's why these very punitive spreads had to be paid. And you can see over time, the donor countries realized that's an absurd idea. If you want to help Greece survive, the spreads must be low. That's the only way how Greece can deal with its debt. You can see the same thing also in Ireland. In the beginning, very high spreads, 250 basis points. BPS means basis points, means 2.5 percentage points. And same thing, Portugal, also in the beginning, high spreads, and then they were reduced. So there was a major mistake in the rescue programs in the beginning, that countries that were really struggling to survive were burdened with unnecessary spreads. And but that changed, and you can also see, while the spreads were more or less reduced to zero, the maturities were prolonged to 30 years, and in the case of Ireland, 15 years. Case of Greece, well, there's another one. So the idea was also to give them long repayment periods somehow to make the debt burden somehow sustainable in the long run. So, and here you can see the redemption profiles. Let's see if we see, let's see here. Greece. It's always interesting. You can see the huge lot of redemption has to be made here on 2065, no, sorry, 2055, 2058. There's also some 2040. So the idea is somehow to get this debt somehow in the future, where it hopefully can be where the debt can hopefully be repaid by Greece. So that's the logic of these rescue programs, to reduce the interest rate burden and also to prolong the maturities, to spread the debt burden over time. And so far, one can say, yes, so far it has worked. And the good news is that also in the Corona pandemic, huge amounts of money were needed by all member states. So far, we didn't have any crisis. We didn't see any increase in the risk premium, the long-term bond yields, and so far, these rescue programs have worked. So then we are already approaching the end. The question is, how will we go on? How can we stabilize the euro area in the longer term? Of course, so far we had this Corona pandemic, and so far a euro crisis was avoided, thank God. But of course, this can be explained by the completely different behavior of the ECB in the euro crisis compared with the financial market crisis in 2008, 2009. Some weeks ago, we have seen that in this crisis, 2008, 2009, 2010, the bond purchases of the ECB were very low, especially compared with the United States or UK. At the same time, the ECB did not reduce the rate to zero. Instead, even in 2011, the ECB even increased interest rates. So the ECB was not very supportive, to say the least, in the euro crisis and also in the 2 years before the euro crisis broke out. And now we have definitively a completely different situation where the ECB is doing what it can with very strong asset purchase to prevent any kind of tension in the euro area capital markets. I think that's really a completely different story, and that's why so far, thank God, the pandemic has not led to any kind of euro crisis, which would have been an additional destabilizing element in a difficult situation. But the question is, how can we avoid this in the longer term? And we know that, of course, public debt ratios are high and they will remain high. We have already seen it, that due to the pandemic in many countries, debt to GDP levels have increased and they have further deviated from the 60% reference threshold of the Maastricht Treaty. And so, of course, the question is, what can we do to deal with this? How can we avoid, once the Corona pandemic is definitively over, that we enter into a new euro crisis where capital markets attack individual countries because they fear that the debt levels in this country are high. So this is a risk which is there and which so far was successfully contained by the ECB's policy. But of course, we cannot be sure that the risk will not materialize again. So, as I said, the key problem of euro area membership is that the member states are confronted with an insolvency problem which does not exist in the similar form for countries that are indebted in their own currency. And that's the main reason why we have seen the euro crisis. And the question is how to deal with the insolvency problem. There are different approaches. There are people who say this insolvency problem is a wonderful thing because if countries are facing the threat of insolvency, it will make them to follow sound fiscal policies. So if they're always constantly in the fear of the financial markets, this will make them be cautious and will be a strong incentive to follow sound fiscal policies. And that's why the German Council of Economic Experts, at least the majority of this council, has developed the concept what they call Maastricht 2.0. So they say no bailout when countries run into troubles, we don't help them, and if the capital markets don't finance them, then we need insolvency procedure. And this should also act as a threat to the financial markets. So if financial markets lend to a country, they should assess the fiscal situation carefully, because if a country runs into trouble, financial markets should know they will lose their money. And so the idea is that this will cause a very strict monitoring of the fiscal policies by financial markets. So that's one approach, and a different approach is to say, okay, this insolvency problem is something which is not stabilizing, but it's destabilizing, because we know that the market forces are not a very reliable mechanism for monitoring fiscal policies. And we've seen it in the case of Greece, where it should have been obvious in the 2000s that fiscal policy in Greece is not sustainable, but where the financial markets did not react. And when the financial markets started to react in 2010 or 11, it was too late. And therefore, the idea is we should not rely on these financial markets as a kind of stabilizer. They are more the destabilizing element. And that's therefore, if you want to guarantee a euro area which is not confronted with such crisis, we should try to reduce the role of the financial markets. And one way to do that is to say, okay, let's transform the national debt into a kind of joint debt, joint euro area debt, like you have the federal debt in the United States, and then the individual countries can no longer be attacked. And the idea of this kind of debt mutualization, the catchword is euro bonds. There are all kinds of proposals for this. I also have made proposals for Eurobond, but for the German public, Eurobonds are something extremely terrible. They do not want to pay for the debt of their neighbors. And therefore, this idea to say, let's mutualize the debt, let's get a kind of federal debt like we have in the United States, so that the individual countries can no longer be attacked. This is something which is not very popular. And of course, if you mutualize debt, it would also mean that, of course, you need fiscal competencies at the euro area level, because, of course, there's a risk if a country, let's say like Italy, if they know they can make all kind of deficit and debt, in the end, they don't have to pay for this debt. This debt is mutualized, and the other member states also guarantee their debt. Of course, this is an incentive to run high debt levels, to run unsound fiscal policies. And so when you go this direction that you say we mutualize the debt, then also you would need some competencies, fiscal policy competence at the euro area level, where there is kind of euro area finance minister saying to Italy, no, sorry, you are not allowed to reduce taxes right now because your debt is already unsustainable. So that's the difficulty of these ambitious approaches, that if you go into the direction of kind of federal debt, you also need a kind of federal finance minister, and that's also something which is difficult to reach right now. So this is a dilemma of the euro area, and it's difficult to solve it. So, and of course, the decision for this, what is called Maastricht 2.0 versus a kind of Euro 2.0 depends very much on how you assess the financial markets. Are they a stabilizer or a destabilizer? And the German Council of Economic Experts has a lot of trust in the financial markets. They say financial markets have resulted in a kind of ex ante disciplining of government budgetary policy, and would thus support crisis prevention. So the idea, the financial markets react timely, interest rates go up, fiscal policy reacts, and then it's a wonderful thing. And the other approach, and I think we have already addressed this, is the idea of this Delors report. We've quoted already that market forces are either too slow and weak or too sudden and disruptive. And I think this is a more realistic approach. But here we are, and it's not easy to find a way out of this dilemma, that somehow if the markets play an important role in the financing of the member states, you're always prone to all kinds of attacks on member countries by the financial markets. And if you want to avoid this, if you say, okay, let's have a kind of federal debt, but then you need a mechanism of kind of political discipline, and this political disciplining mechanism must be at the European level, and it then implies that countries are willing to give up fiscal policy autonomy to the European level. That's something that most countries do not like. And so here we are stuck a little bit, and so one can organize the reform proposal a little bit in this kind of matrix. And one element is the question: what do you think about market discipline? Do you think market discipline is effective and is more effective than political discipline? So do you believe in the self-stabilizing role of the markets, or do you believe that this is not the case, that the markets need to be stabilized by governments? so that markets cannot be trusted to be the kind of disciplining mechanism. So these are this is one element of this matrix. And the other element is, do you think that more political integration is possible? Or do you think that more political integration is not possible? With this, you can of course get four solutions. If you believe that political integration, more political integration is not possible, and if you believe in market discipline, then you get this idea Maastricht 2.0. The idea, let's have stringent insolvency mechanisms, and let's have insolvency regimes, and so on and so on. So that's the idea of this, my colleagues, former colleagues in the German Council of Economic Experts. If you believe in political integration and you do not believe in market discipline, then you get this solution. It's okay. We do not have so much trust in the market forces as a disciplining mechanisms, and we believe that more political integration is possible. Then you get these kind of ambitious solutions. So far, we had neither this Maastricht 2.0 nor we had Euro 2.0. So what we de facto had is a kind of muddling through. And muddling through means no willingness for more formal political integration. This is just not possible. On the other hand, we also know that we cannot rely on the markets as a disciplining mechanism. And so we have to muddy through, and that's exactly what the ECB did. All the purchases of government bonds by the ECB already before the crisis and also now in the crisis is a muddling through process where the ECB tries to stabilize the situation by ample bond purchases and by this reducing the role of the financial markets, of the capital markets, stabilizing the euro area by absorbing a major part of the outstanding government bonds into the ECB's portfolio. And one can say de facto, the ECB is creating some kind of euro bond, because in its balance sheet, on the asset side, you have the government bonds of the national countries, and on the liability side, you have just ECB deposits. And so this is a kind of indirect, implicit form of euro bonds. And as there is no willingness to have more political integration, but as you can also not rely on the market forces to be self-stabilizing, I think there's no alternative. And so here we're stuck a little bit. So we still have here some kind of hybrid forms of Maastricht 2.0 and Euro 2.0. And that leads to the financing vehicle that has been created in the pandemic. So some progress was made in the pandemic, while people in Germany did not like Euro bonds. The Next Generation EU fund is a kind of joint financing of future-oriented projects. So it's debt which is issued by the European Union. So it's not national debt. That's very important. So this Next Generation EU is not something that counts as national debt. So the European Union has used the possibility to issue money for future-oriented projects. And the key element is the Recovery and Resilience Facility, which has 338 billion euro in grants and 385 euro in loans. But the important element is the grant element, so where money is given directly to the member states, and this money is then used to finance all kind of future-oriented projects. So this is a kind of step ahead. So it's not the muddling through, it's kind of something that which has been ratified by all the member states. So it's a willingness to set aside a certain amount of money which can directly be used for investment in member states and which is not national debt but EU debt. So this is a little bit this kind of hybrid form has always been missing in my matrix. I'm very happy now that we have an example for this. So the amount is a lot. So what matters are the grants, 38 billion euro. It's not that huge. It's about 3% of euro area GDP. So if you, and it's sorry, but it's for the whole EU, so it's less than 3% of the EU GDP. So it's much less than what Biden is now investing in the United States. But still, it's a positive element, a positive feature, and it's the innovative element. It's EU debt, and the EU is financing it. How does the EU finance it? So the EU raises funds on the capital market, and the borrowed amounts will be repaid over a long-term period until 2058. And the repayment will be made with own funds by the EU, own resource of the EU, and the EU is trying to raise additional funds for this, especially policies that are related to climate change. So there are carbon border adjustments where the EU could raise kind of import tariff of products with a high carbon intensity. There are digital levies, there is a financial transactions tax, so hopefully the EU will find some funds to refinance. So this is important innovation. And the question is now, is this something unique which will never happen again? In Germany, the idea is yes, this was a one-time event. On the other hand, it could open the door for joint projects, not only for the euro area, but for the EU, to finance the investments that are needed for the huge transformation of the European economy to deal with digitalization and climate change. So far, here we stop. Thank you very much. I think next week, we just use the time to discuss a little bit so far what we've done to answer your questions. So maybe you have all kinds of questions, and I think we should use next week to answer your questions. But also, if you have any suggestions and ideas, we would also happy to hear this. Okay, thank you very much for listening today, and wish you a pleasant week.